Good afternoon, listeners. Today, as usual, we are going to look into a new topic, and this topic is regards to finance. That is the basic tools of finance. When we talk about finance, the literal meaning people take finance to be money, and in economics form, finance means a way of financing a particular business or activity. The process involved and the management of money that's involved is what finance is all about. Finance is a field that studies how people make decisions regarding the allocations of resources over time and handling of risks. Like I said, people take finance to be money. But in this regard, that is the literal meaning. But with respect to finance is the field of the study on how people make decisions. How do you make decisions on the money you are holding for business? You make a plan to go into business. How are you going to handle the means of the managing the resources you are holding for that business? And how are you going to handle risks involved? Because every business involves many risks. So how are you going to handle all the process involved is what is called regard to be finance. Now, the present value measuring the time of money. That is, present value refers to the amount of money today that will be needed to produce using prevailing interest rates a given future amount of money. In this regard, we have the future value, and every money has its own value. Or in financing, there's so many such value in money. We have future and the present value. So the concept of this present value demonstrates on the following. That is, receiving a given sum of money in the present is preferred to receiving the same sum in the future. Meaning that, for instance, to be given 1,000 now is even better to have it now than say till tomorrow before you are given that 1,000, because time value of money. In order to compare value of a different point in time, compare their present value. What can money buy now compared to tomorrow? Firms undertake investment project if the present value of the project exceeds the cost. We have also, this is the formula that used to determine the present value. As if R as a rate of interest, then the amount of money, that is X, to be received in year, that is number of a particular year, has present value of, this is it now. X stand as the parameter now of the amount of money to receive. 1 is constant, and R is the rate, and can be any number, can be 1 year, 2 years, 3 years, is depending on the time. Future value, the amount of money in the future that an amount of money today will yield, giving prevailing interest rates, is called a future rate value. This rule is one of the financial rules. According to this rule in America, if some variable grows at rate of X, that is the amount of money to receive percent per year, then that variable double in approximately at that stage. For instance, now, if you are to receive 1 naira today, if shipped to tomorrow, is expected to have additional value. That means that that naira is supposed to be 2 naira by next year. Now, in business, since finance involves even how to manage risks. Now, what class of risks do you have? A person is said to be risk averse if she or he exhibits the dislike of uncertainty. What is uncertainty? It's something that can happen on determined time or predetermined time. You cannot say this is certain time that this will happen. That the individual can reduce risks by choosing any of the following: one, buying insurance, meaning that if you are in business, you give out you sell out, you register with what? Insurance company. You insure your business, so that in the case of eventuality, when there is any cause of damage, the insurance company may likely to pay you all or take some percentage of the loss you have made, so that to recover back to you. Diversity also, moving from a single proprietor business to the large business. You have to move and change your business patterns. Accept a lower return on the investment. That means that you have to go into the big business, where you have to join venture instead of operating the business alone. This is a utility of accepting or aversions over risks. You see, this is a utility, and this is the current of wealth and health. This is indifferent curve. At this stage, these are the stages where the utility of utility lose from the losing of 1,000. And also, this is what? Losing of what? 1,000 also. And this is the gain of 1,000. It's just utility gain from winning the 1,000. The satisfaction, the risk involved, once you are in small business or you business entity alone, there is tendency of having higher risks of loss compared to when you are in the large business. Look at it. One way to deal with the risks is to buy insurance. Like I said, that is general feature of insurance contract, is that a person facing a risk pay a fee to an insurance company, which in return agreed to accept all or part of the risk. And sometimes we have diversification, so refers to what? The reductions in the risks achieved by replacing a single risk with a large number of smaller or related risks. Also, idiosyncratic risks is also so-called systematic risks. Is a risk that affects only a single person. It only affects single individual as a person, because the business is at risk then, where the uncertainty associated with a specific company. For instance, a single company is facing with the damage of its machineries. Such a loss, when it comes, it will affect its productivity. So such a damage or loss, it affects peculiar to that only company in particular. It doesn't reflect all. The aggregate risk is the risk that affect all economic sectors at once. The uncertainty associated with what? The entire economy. Let's say when there is economic meltdown. Disasters that affect all the business sector, all the economic sector. Maybe there is fear and the security challenge that lead to the loss of the business entirely, which is very minimal compared to the other risks, that is idiosyncratic or systematic risks. Aggregate risk is far better because it's usually used to become small in nature. Diversification cannot remove aggregate risks. Yeah. Look at it. This is at the level. This is the aggregate risks from this point. This aggregate risk is a risk that involves general loss or effect to the economy. Well, the idiosyncratic risks or systematic risks is always at larger stage because it affects single company. But the level of risks in aggregate risks, it affects general economy, which is very small in nature. People can reduce risks by accepting a low rate of return. Look at it here. Mean that this no stock at that instant, that is the beginnings of the business. Well, this stock at 25% when the business start moving. 50%, 75% to 100%. It entails that the trade-off between the risk and return is always when the business is at higher, the tendency of the higher possibility of the risk of the business, the better the possibility of the more gain. So in this case, when the stock is 100% level, it have more gain. That's the return is very high compared to when it is 25% shock. That is the stock at what? 75% or 50%. So the higher the standard of risks, the higher the return of percentage higher. Now, valuation of asset, that is fundamental analysis. When we talk about asset valuations, is a system where somebody should buy, a person should value an asset before going into investments with that particular business. Where is a study of the company's accounting statement and future prospects to determine its value. What is the value of that company? For you to buy it, is it undervalued, overvalued, or valued exactly, or fairly valued, I can say. The main here, people enjoy or employ fundamental analysis to try to determine if the stock is undervalued, overvalued, or what? Fairly valued. The goal is to buy what? The undervalued stock. Any stock you want to buy to go into investment, it must be the main goal of the buyer is to ensure that whatever is buying is undervalued, so that in case of eventuality, next time you want to sell out, you will sell at profit or at dividend higher than he bought. Now, efficient market hypothesis is a theory that asset price reflect all publicly available information about the value of an asset. This is just trying to explain how price is known in the market. There is no hidden in price. That is, the market is informally efficient when it reflects all available information in a rational way. If markets are sufficiently efficient, the only thing an investor can do is buy a diversified portfolio. That's random walk and index fund. Random walk, that is the random movement, referred to the path of what? Variable whose changes are impossible to predict. If markets are efficient, all stocks are fairly valued, and no stock is more likely to appreciate than other. No stock price follow a random walk. Now, in summary of what we have discussed, because saving can be earned interest, a sum of money today is more valuable than sum of money in future. That's what it means. A person can compare sum from different time using a constant of present value. The present value of any future sum is the amount that will be needed today, given prevailing interest rate, to produce the future sum. Because of diminishing marginal return or utility, most people are risk averse. Risk averse people can reduce risks using insurance through diversification and by choosing a portfolio with lower risk and lower return. The value of an asset such as shares of stock equal the present value of the cash flow the owner of the share will receive including the stream of dividends and the final price. According to the efficient market hypothesis, financial market process available information rationally. So a stock price always equals the best estimate of the value of the underlying business. Some economics question the efficient market hypothesis. However, they believe that irrational psychological factors also influence asset price. Meet next time. Thank you very much.